见过 Ryan，Ryan 是我们的 rep，OK，、然后Office 3个 manager Grace，Grace 是礼拜二、礼拜四来 Office，Casey 礼拜一、礼拜三来 ，Lily 是礼拜五，所以你们来的时候常常看不到，不会在一起。OK， 所以我现在让你知道，趁这个机会介绍一下，说你来说，今天他怎么没来？不是他没来，是轮休。OK， 那这礼拜一到礼拜五谁在那里？我在那里。OK。这老板最可怜了。OK，Alright，other than that， 我想有几件事我先跟你们 update 一下哈，因为我礼拜六在办公室接到了 ARC， 应该是 ARC Global 的电话，Global 2， 因为有 Global 2的人 ，ARC Global 2要 merge 跟 GNL， 就是原来的 ARC Global 1。它 merge 的价钱只有20块钱左右，所以我的建议是你们都 vote for no， 这个是很少数我跟你们讲 vote for no 的。The reason 是我希望 management 要知道说 they need to work for you， 不是 work for 他们。我不能跟你确定说我们 vote for no eventually 会 help 我们那 I don't know 其他的人，可是我的建议是 vote for no。所以因为他的 reason 是说 GNL 会涨，我到现在没看过它涨，所以 forget it。虽然说你 merge 好处是 merge 以后你可以 get out， 可是我想 let's do something， hopefully they can make the change， 他的卖。另外一个是 ARC Retail Center， 它的 proposal 是 merge with American Finance Trust， 以前的 ARCT5， 它 merge 的 result 是10块2毛，我第一次看到是觉得还不错，至少我们 get out 了。可是 the problem 是American Finance Trust 还是一个 non-traded REIT。所以你 merge 过去以后，你大概 10% 的 cash 拿出来，其他的变成 ARC Finance Trust， 还是 non-traded REIT， 还是在里面。所以我也要劝你们，我建议你们 vote for no。那因为有些东西我没有办法 email 上写。我已经打电话，该打电话我就打电话了。你今天来了，我趁机跟你讲。那还没有的 ，let's do something。因为这个 deal 是 Lincoln Property 在 manage，manager 一直想把它拿出去卖。我相信他会卖的比较好的价钱 ，I don't know exactly。可是 Board 呢要把它 merge，OK， 所以我建议大家是 vote for no。OK， 你有没有很少听到我叫你们 vote for no 的 ？OK， 这2件事我要拜托你们，不管他是打电话给你，是你收到 email。OK，simple 就是 GN Global 2要 merge with GNL，vote for no，against 不要 vote for for。OK。ARC Retail Center merge with American Finance Trust, vote for against， 就这么简单。还有问题？这边还有位置。任何人有问题，拜托打电话给我。有时候我没办法在 email， 你留话我一定会回你的。你 ARC5 要买 ARC Retail Center， 那 for ARC Retail Center, I don't see that's a good deal。ARC5 没有问题 ，OK， 如果你有 GNL 还没卖掉的人，自己找个位置坐，好吧？如果你有 GNL 的人，如果你要 vote 的话，因为两边都要同意，你也可以 vote for no， 不影响。可是如果你要 vote， 你也可以 vote for no， 那个不影响它，是我们 GNL 2的人才有影响 ，OK？ 所以不占用太多时间，因为今天是 Moody 要来讲。那 Moody 前一阵子我送了一个 email 说他要merge with Moody 2，Moody 2还 open， 那 Moody 1已经 close for 1年多，所以刚好 Mr. Moody 呢他来这个 area 说趁这个机会让他做个演讲，然后解释一下。他当然还有2个目的，一个是解释 Moody 1、Moody 2怎么 merge， 另外一个是他当然要 sell， 所以他要 talk about Moody 2。那在这里我想我算了一下，大概70-80%的人有 Moody 1。还有人 Moody 2， 然后还有一些新的人还没有 1 或 2的，那想听一听 either one， OK， 你都可以听到。那我想我就直接让Moody讲，希望你们有问题尽量问，因为这个 deal 我不是不清楚，可是我先不讲，让你们自己去判断 ，good or bad whatever， 那你有问题尽量问，不要回家以后又跑来问我，你还可以问我了，没有关系了 ，OK， 我只是希望你们，他好不容易请他来一趟，他从 Texas 来，所以他来了一趟，你就尽量问他。Alright, Brett, I think I've talked enough. I want you to talk about all the stuff. I think Paul already told you. people want to hear about what, 1 and 2, whatever.
1 and 2?
Okay?
Okay. Should I start a little bit and tell them a little bit about what I do and who we are?
Yeah.
Should we do that, Paul?
Put a little higher so people can hear.
Oh, I have a clicker. That's loud. Thank you. I'm honored to be here. Thank y'all so much. Who was here a few years back at lunch? Do you remember the lunch? Where was the lunch? Nick's Chop House. Is that right? Dinner. That's right. And some had lunch. And at lunch, remember, I took the phone call and I lost that deal. That was dinner. I thought that was lunch. I lost that deal. Was that at night? That's right, because it was 5 o'clock on the Pacific coast, on the West Coast. That's right. But some deals you win and some deals you lose. So for y'all that weren't here, I was in a bidding war, and with a group from China, and they beat me. They won. Yes. So they paid more money, but that's okay. So it was good. But it's been a good few years. So thank you all for coming tonight. I will stand out of the light over here. For some of y'all that don't know, I'm with Moody. I'm Brett Moody with Moody National Companies. We've been in business over 20 years. I started back in college at the University of Texas in Austin. I'll never forget, I lived in a dorm room my freshman year, and then I went to lease an apartment my sophomore year, and there was a box there, and it said realtor. And I said, "What's this?" He says, "Well, if you have a realtor, they get a commission of 1 month's rent." And I said, "Well, I don't have a realtor, but I have 30 friends. And you mean if they put me down as their realtor, I'll get 1 month's rent 30 times?" He said, "Yes." So I ran down and got my real estate license. I made $30,000 leasing my friends' apartments. I said, maybe I shouldn't go to school. Maybe I should go to real estate. And so anyway, that was the start. That was in 32 years ago. That was when I was 20 years old in 1984, my sophomore year at the University of Texas at Austin. And anyway, since then, we started Moody National Companies. And we like all real estate. We like office buildings, we like apartments, we like all different types of real estate. But we want to read the reports and study the math, and we want to deploy assets or invest in the asset class that we think is going to outperform the other asset classes. So at 10 years ago, it might have been multifamily, and 5 years ago, it might have been office buildings. But for the last few years, it's been hotels. And hotels were really beaten up in the Great Recession back in 2008. And they had about a 40% drop in value. And now they've been coming back, and they're probably 10%, 15% off normal pricing. But it's been very attractive to pour money into that asset class, and it cash flows. For all of you that are in REIT 1, we've been paying an 8% now for the last 5 years, 4 years. I don't know how long most of you have been in, but that's been a very nice cash flow. It's harder to make that kind of cash flow now. We pay a 7% cash flow in REIT 2. But what was nice is we valued REIT 1, and then REIT 2 made an offer to purchase REIT 1. And so we are now in a go-shop period. And a go-shop period is when the investment bankers take our offer out, and then they show the entire market and let anybody in the world can make a bid for REIT 1. And if they bid higher than us, then they win that bid, and that's really good for REIT 1 shareholders. But we put a good offer forward, and so I hope that REIT 2 wins that offer. But it doesn't harm me at all if our shareholders are paid more money by someone else, and we'll allow the market to decide whether our offer is highest or not. And so that should come out at about the end of March. So at the end of December, we'll know if somebody bid higher or not. And if not, you'll receive documentation if you're in REIT 1 in January that'll tell you about the transaction, and you get a choice. You can either take cash or you can contribute. If you contribute your interest into REIT 2, then you avoid your capital gains and have no capital gains taxes. And so you'll sit down with Dr. Chen, and he will explain whether that's an appropriate investment for you to take cash or to take stock. And if you don't like the deal at all, you can vote against the deal. So that's a good thing about being in a democratic system. They can vote. If you don't like it, you can say, no, we don't like the deal. We'd rather just stay right where we are. But it's good to prove up and the business model and deploy the money, receive the cash flow, let it gain a little bit, sell the portfolio, redistribute the money back in again, and do it over again. So we're excited about that. It creates a great opportunity for us. I'll tell you just a little bit about, and Dr. Chen, you can tell me at any time if you want me to cover something else. We started in Moody, let me see if I can get a laser. There's a laser. We started with Moody National Mortgage Corporation in 1996. And we were Merrill Lynch's #1 producer, originator of real estate loans that year, and they were the second largest lender on Wall Street. And then in 1998, Moody National Mortgage was Goldman Sachs's #1 originator of real estate loans across the country for Goldman Sachs in 1998. And then we took our profits and began to develop apartment buildings and office buildings, medical office buildings, and condominium projects. And then we wanted to manage that which we were developing, so we started our management contract. And then we formed our realty company because we wanted to put a structure in place that we could provide products to folks like yourselves. And there were two structures. You can go out and raise institutional money, but I did not like the institutional model. Is when we started putting money out for institutions in our mortgage company, it went like this. There, am I live there? So we'll say Mr. and Miss Johnson. So Mr. and Miss Johnson would put their money in their pension fund, and their pension fund would hire a pension fund advisor, and the pension fund advisor would have a stocks advisor, a commodities advisor, a bond advisor, and a real estate advisor. And that real estate advisor would then go out to the individual markets and find a real estate development company, and then they would put that money into the real estate. If the real estate did very well, then the real estate company would get paid, the mortgage banking company would get paid, the real estate advisor, the pension fund advisor, the pension fund would take theirs, and Mr. and Miss Johnson would get the pennies left over. And that we call that a brood of vipers. And so we did not want to be a part of that system. And so through the independent broker dealers like Centaurus, like IFG and many others, and Dr. Chen's with Centaurus, that you could take Mr. and Miss Johnson and they would go to a Dr. Chen and he would go right into the real estate. And so then we take the money right from the real estate. The client gets 100% of their money back and they get a preferred return before the real estate company makes money. And then they get to share. They get 15% after the investor has all their money back and has had an 8% preferred return. And then after that, then they split 85-15. And that was a much more appropriate system than that brood of vipers of everybody along the way getting paid on the pension fund money. And so we've enjoyed that. We've syndicated almost $2 billion. We have 1,200 employees and have done almost 46 different real estate offerings. And we've done about 2 different public offerings. Syndicated $1.6 billion. That's a little old. It's a little more than that now. We've owned and operated 65 hotels. Now it's about 4,000 apartments and over 1 million square feet of luxury office. But on the hotels, the reason that we like hotels and have liked them and still like them is that there's a huge supply-demand imbalance. There just haven't built enough hotels. And actually the one area in the world that they have is probably Washington. In this area, they have built a lot of hotels, and there have been a lot of hotels. New York has plenty of hotels, but in general, most major metropolitans around the country have had an insufficient supply of hotels. And that is great for the hotel owner because we get to raise the rates up and up and up and up and up. And so the rental rate growth on hotels has been almost double, sometimes 3 times what the rental rate growth in some of the other real estate asset classes have been. And so we've really enjoyed that. That's what's helped us pay our cash flow, and it's been going well. But now we just don't buy any kind of hotel. We don't buy luxury hotels. We would never buy a big full-service Ritz-Carlton or Four Seasons. Those hotels make a ton of money in the good times, but in the bad times, they cost a lot of money. So to me, they're for really, really wealthy companies to buy, not for retirement money. So we would never put retirement money into these hotels that have these huge swings up and down. So we would buy like a Marriott Courtyard by Marriott. We only buy Marriott, Hilton, and Hyatt. And we only buy what we call select service hotels. Has anybody ever stayed in a Marriott Courtyard or a Hampton Inn? Those are the types of hotels that we would buy. One of my favorite courtyards is the big one down in Tyson's Corner. It's just right in the middle of just everything, and it's a select service hotel, so it gets a really big rate, but doesn't have 3 restaurants and 2 lobbies and 40 people running around out on the grounds. It's very easy to operate, and it has lower volatility in the good times, in the bad times. And so the Marriott Courtyard is kind of the category killer. It's the leader of all the select service, and it competes against the Hilton Garden Inn, which is owned by Hilton. And then in the upscale, the Embassy Suites is almost a 2-room. It's kind of like a suite product, and it competes against the Spring Hill Suites and the Hyatt Place. I like the room of the Spring Hill Suites, and I really like the Hyatt Place, but there's just not enough of them. There's about 200 Hyatt Places. I want to say there's about 400 Spring Hill Suites, but the Embassy seems to have a much better presence, and it does really well in that space. But these are very good hotels, and the Embassy is the leader of that pack. And then in the economy sector, the Fairfield Inn by Marriott and the Hampton Inn. Has everybody stayed at a Hampton Inn? It's a great hotel. It's a great brand standard all across the country. The standard is very consistent. Years ago, Westin came out with the Heavenly Bed. And Hampton was the first of the select service to kind of copy that, and they double wrapped the duvet in laundered sheets. And so nothing in that room has been touched by the previous guest. Everything is laundered. And so in about a year's time, every other brand followed suit and followed that Hampton Inn concept of double wrapping that duvet. And so that was a big hit, and it's done really, really well. And then the extended stay product, the Residence Inn by Marriott, that has a full kitchen. It has a stove top and a refrigerator for somebody who's going to be 2 or 3 weeks in the room and need a full kitchen and want to prepare their meals there. And so the Residence Inn is one of our favorites. We own one in REIT 2 in Austin, right at the University of Texas, as a matter of fact, where I went to school. And then the Homewood Suites is the Hilton product. And then the economy sector is the Town Place Suites for Marriott. And there's something called a Home 2. The Securities and Exchange Commission, SEC and FINRA, will not let me put their logo up because we do not own a Home 2. And we don't own a Hyatt House, which would go right there. And they only allow us to put assets up that we own. But those are 2 brands that we like, and we may buy someday. We just don't buy now because they're new. And I like to buy a brand. I don't want to build a brand, right? I want to buy a brand. What we say in the hotel business is Marriott, Hilton, and Hyatt put heads in beds. And they have a great reservation system, and so we want to count on that. Just like they have a loyalty program for airlines. If you fly the same airline, you get the miles. Well, people that travel want to stay in the same type of hotel because they build up points. They get to go to Hawaii at the end of the year and stay free from all their points. So if you travel a lot. So the loyalty programs are very, very important, and we like that. There's another thing we like about the hotels. It's called Area of Protection, or AOP. When you build the Courtyard, Marriott Courtyard in Tyson's Corner, there's not going to be another Marriott Courtyard in Tyson's Corner. You own that brand in that location, and you pay Marriott for the rights to operate that hotel, and they won't build one right on top of you. And so if you build an apartment complex, they can build another one and another one and another one, or an office building. But to have brand protection has always been an attractive feature of the hotels. And then there's another thing that we try to do. So we want to buy the asset class that outperforms all the other asset classes. We want to buy the type of hotel that's going to outperform the other types of hotels. And then we want to buy in the states that are going to outperform the other states. We have long since, and we don't go on how we feel in the morning. All the decisions we make are math. We like to say we're a math-based company. There's a lot of reports out there, and we can look at who had the greatest rental growth in the hotel sector in the last 20 years, year in, year out. And it'll be these states, the East Coast, the West Coast, and then the Sun Belt states. When I say Sun Belt states, it's not really all the Sun Belt. We don't buy in Alabama, Mississippi, Louisiana, or New Mexico. Those aren't major markets, so we would not buy there. But we'll buy in Florida, Texas, Arizona, California. And so we want to buy in these states that are going to outperform the other states just year in, year out. Real estate, I want to buy something and I want to make it better, but really what we want to do is buy something that the math is on our side and the entire sector is going to rise. Does that make sense? I want to be able to buy something that I know has the historical income to pay the distribution that we're looking for. We call it dollar good day one. We're never going to buy an asset that isn't already yielding the fruit that we want from that investment. So we're not buying a story. That's for a reality show to fixer upper or something like that. We're not buying something that's broken and fixing it. We're not buying something hoping that it's going to get better. We're only buying something that the cash flow is in place, has been in place, and that'll pay the distribution that we're looking for on our money. And so we buy that asset, and then we hope that because of where the market is and what the math says, that it will increase in value, continue to pay that distribution, and then increase in value over time. We're not here to try to make you a 30%. We're not here to make you a 20%. We're here to pay you a distribution, number one. Number one characteristic of our REIT is a fixed income product. We want to pay you that distribution and pay it every single month. REIT 2 paid in 8. REIT 1 paid in 8, REIT 2 pays us 7. We're not in the Great Recession anymore, so pricing's leveled out a little bit, and that's why we pay the 7 today in REIT 2. And that's the number one thing that we're trying to do, deploy that money that'll pay that distribution. And then we hope that two things just come along with that, and one is non-correlated. The stock market goes up and down, but an operating business is much more stable. It's not traded on fear and greed like the stock market. So we're non-correlated to the stock market. And then the third thing characteristic of our REIT is that we move in lockstep with inflation. It's called an inflationary hedge. Now, why is it an inflationary hedge? I'm glad you asked that question. The inflationary hedge is that sticks and bricks, or what we call fixed assets, move along with inflation. Why is that? Because as inflation occurs, land prices increase. The cost of labor increases. The cost of the building and the sticks to build the building increases. So for somebody else to come along and build the building like yours, it's going to cost them a lot more money. So your product should be increasing along with inflation just because of the cost to replace that asset. So the replacement cost moves up, plus your room nights. In a hotel, we get to change the rents every single day. So as inflation occurs and the price of bread and milk go up every day, we get to change our leases every single day as it goes up. Now, it can hurt you in a recession as well, and that's why we buy assets that have a cushion and have a buffer in case we have a pullback. But in general, we want to buy our assets that we can change those rates every day in a growing economy, in a growing market, and that's why we're in the hotel space. And then with that said, we want to be in the major markets that are going to outperform the other markets. And so we really believe in what I call the rise of the rest: Brazil, Russia, India, and China, BRIC. We believe that as those countries grow, they're going to continue to expand. And the way that America is going to benefit from that is for our large companies that have already been through the Industrial Revolution to joint venture with some of those other companies. So things like when we look at the Bay Area in the San Francisco area is a 33% Asian population, 24 Fortune 500 companies with Asian exposure on their balance sheets to the Pacific Rim. So we think those companies are poised to do very, very well and to partner with and to continue to partner with the Asian Pacific Rim and also in Brazil and Russia and India, all the other BRIC countries. And so those large Fortune 500 companies when they begin to do joint ventures, it will create travel, it will create jobs, it'll create more pressure on that real estate, and they will outperform some of the other major metropolitan markets in America that don't have those similar dynamics. Seattle is another good one. They have Amazon, which is just absolutely destroying some of the bricks and mortar retail, traditional retail. Amazon is amazing. They have Amazon Now. Some friends of mine the other day, they're Baby Bijon. It's a baby holder, like a backpack that goes in front, and it broke. And they didn't know where to find a store. And the guy just pulls up on Amazon. They were in Chicago. And says, well, just order Amazon Now. He orders it. 20 minutes later, the front desk called and says, your backpack's here. And, I mean, just deliver it. It's just amazing. And so, and that grows. So we actually have a hotel across from the Amazon headquarters in downtown Seattle in REIT 2. They had 1 million square feet. They just took on another 1 million square feet, and they announced they're going to build 2 new high-rises and have 4 million square feet right out in front of our hotel. So we're really excited about that hotel and its success with Amazon. But that's why we like Seattle. They have Microsoft, they have Boeing, they have Starbucks, and those companies have done very, very well, and they're also expanding in the BRIC, in the Brazil, Russia, India, and China. So we like the impact that they're going to have around the world. And then Oregon, the reason we like Portland is it's just very difficult to build there. So if you ever buy a hotel there, you don't have to worry about new supply. By the time somebody buys the land and gets it through the entitlement process and gets the approval to build, and they build for 2 years, and then they get open, we'll have already purchased, increased our value, and sold long before they get it built. It's just too hard. We call that a hostile municipality. They're tree huggers, and they do not want people to build new buildings. And so if I can find a good asset there, I know that there's not going to be a lot of supply because they don't let anybody build. It's very, very hard to build. So that's why we like Portland. We love the LA. They are the largest port to the Pacific Rim. And so they have, I think it's 161 like billion tons. It's a huge number that they run through here. In Phoenix, we kind of like Phoenix. Phoenix is tough for the hotel. We more like it probably for apartments, but in the hotel space, they have so many people from North Dakota and Minnesota that we call them snowbirds. They're freezing up here, and they all come down to stay in Phoenix. And the problem is, if you ever had a bad economy and all the snowbirds don't come down, then you'll have these huge resort rooms competing with my Hampton Inn. And I don't want somebody offering a $200 resort for $129 competing with my Hampton Inn. So the Phoenix is a little tough on the hotel space, but I like Phoenix as a whole. And we're negative on Houston because of the oil and gas, but we really like Austin, and we really like Dallas. Speaking of Austin, we like Nashville, Austin, and Phoenix because we call them junior Silicon Valleys. You used to have this concept of startups in Silicon Valley, up here in the valley between San Jose and San Francisco. Now, they used to start them in a garage and say it's a startup in a garage. Well, do y'all know how expensive a garage is in Silicon Valley? It's like $200,000. There's no startups in garage. They can't afford it. So what we have junior Silicon Valleys, which will be like Nashville, Austin, and Phoenix. And you're starting to see more and more tech companies move into those areas because they can attract millennials that actually have a reasonable rent and can actually afford to live there. Because it's very, very difficult, very, very expensive to live in the Bay Area. And so those are some markets that we're attracted with. Of course, we love this area. We love Tyson's Corner, which is a MAC, called a Massive Activity Center. It was here yesterday, and it's here today, and I can assure you Tyson's Corner will be here, in 20 years from now. It's just an incredible area. So we like infills areas that have a multiplicity of demand generation. I don't want to be in just tech or just financial or just the oil and gas. If you're just exposed to one industry and something happens to that industry, it can really impact your real estate. So we want to be what we call in the middle of a multiplicity or multiple demand generators from all the different industries. An airport hotel does that for you because every single industry comes through major airports. So we don't mind an airport hotel. We have a great one in Dallas, as a matter of fact. And then as we go up, one of the greatest markets as well in the future for us is the whole Northeast Seaboard. Philadelphia alone boasts like 30 major universities. I don't believe that, by the way, but their Chamber of Commerce does. And they do have a lot of universities, and all the way up from Boston College and Harvard and MIT. So as our Fortune 500 companies JV with these large corporations in Brazil, Russia, India, and China, they're going to need to tap the greatest, kind of